Hello and welcome to Credit Compass, your guide to navigating European credit markets. Over the weekend, we got results of the Hungarian election with a sweeping opposition victory ending Viktor Orban's time in power. The Strait of Hormuz remains largely shut, and the IMF now says that is starting to weigh on global growth expectations. In the UK, first quarter lending data was supportive, even if conditions may have already softened since then. And in primary markets, debt sales are hitting records as higher yields regain investor appeal. Finally, we look at a recent ECB proposal on how European banks can become more competitive without sacrificing protections, or at least the non-political ones. All right, let's start with the election in Hungary. The opposition has come into power with a two-thirds majority. That is positive development for liberal democracy in Europe. But while it is clearly a positive result, it will take significant effort and time to reverse 16 years of authoritarian drift in Hungary. Hungary's economy is small relative to many other European economies, roughly 1 to 2% of European Union GDP, but it has meaningful potential. The challenge for new leader Peter Magyar begins with repairing the country's sizable budgetary problems, passing laws that improve Hungary's standing within Europe and unlock frozen funding that could help offset the need for harsher fiscal tightening. Unlocking that funding would support the country's development. It would also help Europe more broadly because Viktor Orban had become a major obstacle to European progress. He was most infamous for blocking funding for Ukraine, but he also vetoed a minimum corporate tax, EU stimulus measures, tariffs on Chinese electric vehicles, and legal frameworks involving foreign partners. Markets are viewing this election as a positive step toward unlocking development in the country. The Hungarian equity market, yes, there is one, rose sharply on the result, while the foreign and bond markets also strengthened, building on already positive momentum in the run-up to the election. All right, now let's turn to the UK. The Bank of England recently released its 2026 first quarter credit conditions survey, reflecting lender feedback during the first quarter. And it shows a credit environment that remained cautious, but with some signs of stabilization in specific segments. For households, lenders reported tighter credit availability, particularly for unsecured borrowing. Mortgage availability, though, remained positive, but less so than in the fourth quarter of 2025. Demand declined in both areas, especially among home buyers and unsecured borrowers. On credit performance, the picture was a little bit more nuanced. Stress had been easing in prior periods, but default rates on secured lending, mainly mortgages, were reported as higher, with expectations that they would improve in the second quarter. In unsecured lending, defaults also rose somewhat in Q1, though lenders still expect elevated but gradually improving performance going forward. For corporates, credit availability to large firms was broadly unchanged, while small and medium-sized enterprises saw somewhat better lending conditions, albeit alongside subdued demand. Among those groups, medium-sized enterprises appear to have the weakest demand expectations for the quarter ahead. From a timing perspective, the survey is only a snapshot of lender behavior and expectations as of the first quarter. It captures a phase in which credit conditions were only just beginning to face the large swings in the yield curve. Crucially, the survey's own forward-looking expectations point more towards stabilization than fresh deterioration, especially in household credit and mortgages. The survey responses covered a period that bridged the early phase of the Iran conflict, so rate and credit expectations remained relatively constructive at that point. It will be interesting to see how much that changes when the next round of lending data arrives. Now, on to the meatier part. On Tuesday, the IMF released the assessment of the impact of the closure of the Strait of Hormuz and what that means for the global economic outlook. The IMF's message is that Europe is entering another period of slower growth, renewed energy sensitivity, and stickier inflation risk. In the IMF baseline, Europe grows 1.4% in 2026 and 1.6% in 2027, while what they refer to as advanced Europe grows at 1.2% in 2026 and the euro area 1.1%. The immediate driver is the Middle East war, which the IMF says is testing the global economy through higher commodity prices, firmer inflation expectations, and tighter financial conditions. All relatively obvious up to this point. For Europe specifically, this is not just about a softer growth profile, it is a shift back toward the old European macro problem. External energy shocks feeding domestic inflation, while growth remains too weak to absorb them comfortably. In that sense, Europe looks less like a classic overheating economy and more like a region facing a tax on real income. The IMF's own language is that energy importing economies are more exposed and that Europe is again confronting something close to the 2021-2022 gas shock, although I think we are still a ways away from that severity. Another likely consequence is a sharper fiscal tension between defense spending, social support, industrial policy, and debt sustainability. There may be a short-term boost for some manufacturing and industrial names, but sovereigns that already have limited fiscal space may begin to feel this more clearly as spread risk. The report points toward wider divergence between economies with better energy insulation, stronger tourism and services exposure, healthier household balance sheets, or lower import dependence, and those with high gas intensity, weak productivity, fragile fiscal buffers, or manufacturing sectors that are still struggling with high input costs. That divergence is already visible in the country forecasts. So which countries look most exposed in macro terms? Well, Italy is the clearest large economy casualty. It has meaningful gas dependence on its energy mix. The IMF explicitly flags it as exposed, and its 2026 growth forecast is only 0.5%. That is exactly the combination you do not want in an energy shock, heavy input cost sensitivity paired with weak growth. The United Kingdom also screens as highly exposed. The IMF explicitly names it because of gas-fired power reliance, and the UK's 2026 growth forecast is just 0.8% and a meaningful slowdown from the 1.3% in 2025. Hungary is a considerable second-tier vulnerability. Natural gas remains a large part of its energy mix, and the economy has already shown how prone it is to inflation and external balance volatility during energy shocks. It is also still reliant on Russian energy and will need to reduce that dependence to meet EU requirements. The IMF expects only 1.7% growth in 2026, alongside a slightly negative current account. Ireland and the Netherlands are also structurally sensitive on the gas side, although their overall macro resilience is better. Ireland's headline GDP is distorted, so domestic vulnerability is harder to judge from GDP alone. The Netherlands has more buffers, but gas remains an important energy source, and industry is still sensitive to higher energy prices. So, which economies look more protected? Well, France is better insulated because nuclear power still accounts for a large share of electricity generation. Nuclear represented 40% of France's available energy in 2024, and France produced 58.6% of all EU nuclear power that year. Spain also looks better positioned. The IMF explicitly placed it among the relatively protected economies because of stronger nuclear and renewables capacity, and Spain's 2.1% growth forecast for 2026 supports that relative resilience. Sweden, Latvia, and Estonia are also structurally less exposed on import dependence. Eurostat shows very low dependency in Estonia and low to moderate dependency in Sweden and Latvia. Sweden in particular benefits from a substantial renewables and nuclear cushion. The IMF's April 2026 World Economic Outlook suggests that overall, Europe is moving into a phase of weaker growth, energy-driven inflation risk, and wider intra-European divergence. The biggest shift is not a collapse, but a reordering. Energy structure matters again, almost as much as normal business cycles' strength. Also on Tuesday, the ECB released proposals for regulatory changes aimed at improving the competitiveness of European banking. There has already been extensive debate over capital rules, especially as many banks were approaching compliance with what was supposed to be the final stage of post-crisis Basel reforms, often referred to as Basel IV or the Basel Endgame. Since the change in administration in the United States, debate has intensified around possible U.S. regulatory shifts and, by extension, around the global competitiveness of European banks. The ECB proposals are a response to the European Commission's public consultation on the competitiveness of the European Union banking sector. To me, the proposals sound very reasonable and should be implemented. They offer an opportunity to improve the European banking market, increase internal competition, and build banks that are stronger, more European, and more globally competitive. The proposals center on greater integration and simplification. The crucial point is that the ECB is trying to reduce the cost of fragmentation without signaling any broader weakening of capital rules. In other words, this is a better returns through better plumbing story, not a deregulation story. So, what exactly is being proposed? Well, in practical terms, the ECB is calling for 5 main changes. First, it wants greater cross-border freedom for capital and liquidity within euro area banking groups. The idea is that banks operating across multiple countries should be able to move resources more easily around the group, improving efficiency, diversification, and scale. Second, it calls for progress on banking union, including concrete steps towards a European deposit insurance scheme with a clear timetable. The ECB sees equal protection of deposits across the euro area as essential to building a genuinely integrated banking market. Third, it urges policymakers to deepen capital markets by advancing the Savings and Investments Union. This is broader than banking alone. The ECB is effectively saying that Europe needs stronger market-based finance alongside stronger banks. Fourth, on the rulebook itself, the ECB wants simplification without deregulation. Specifically, it proposes moving banking rules from directives to directly applicable regulations in order to reduce national differences in implementation, merging 5 macroprudential buffers into 2 to simplify the framework, increasing proportionality for smaller banks so that requirements are less burdensome where appropriate, streamlining reporting requirements, and giving authorities greater responsibility for taking a more holistic view of overall capital levels. Lastly, the ECB explicitly states that simplification must not come at the expense of resilience. It argues that post-global financial crisis reforms restored confidence and that safeguards such as the output floor and the prudential treatment of non-performing loans should remain in place. It also says there is no evidence that current capital requirements have materially impaired euro area banks' lending capacity or efficiency. So, the strategic takeaway is straightforward. The ECB is not asking for looser banking standards. It is asking for a more unified and less fragmented European banking framework so that banks can compete better across borders while preserving financial stability. That said, while the ECB can advocate, implementation still depends on EU policymakers. The deposit scheme has been politically difficult for years, and freer movement of capital and liquidity within cross-border groups can easily run into national resistance, especially during periods of stress when local authorities prefer resources to stay at home. So, markets should distinguish between the directional signal, which is constructive, and the execution risk, which remains substantial. Shortly after this proposal, though, BAWAG, the Austrian bank, acquired the Irish lender Permanent TSB. It is a cross-border deal that one hopes will not meet the same nationalist resistance that has frustrated so many others to date, although neither are major national champions. So, where do we stand in markets? Well, volatility is beginning to subside, even if it still swings with each new headline. As that volatility eases, a slow but visible pipeline build is starting to emerge, especially with the week having opened on a more constructive tone. Add to that the regulatory developments that could help open up European capital markets. As part of the banking consultation discussed earlier, the European Commission proposed raising the cap on UCITS fund holdings of securitizations from 10 to 15%, and the ECB went even further, suggesting that it should rise to 20%. Both still argue that some cap should remain in place for investor protection, even though securitization is arguably one of the most transparent asset classes in the market, albeit one that remains nuanced and complex for non-specialists. This should support the European securitization pipeline and help expand the market. At last, perhaps some genuine progress on a long-standing capital markets union project. In terms of pricing, spreads have been relatively stable and constructive recently. Yields, however, have continued to move wider. The UK paid its highest coupon on a 10-year bond since 2008, but it also attracted a record level of demand with £148 billion of bids for £15 billion of issuance. That pattern of higher sovereign yields is likely to persist as inflation risks remain elevated and governments consider new fiscal measures to cushion the economic impact of higher fuel prices. We've already seen that in Ireland, where fuel protests led to a €500 million package of support measures aimed at lowering prices. Anyway, that's all for this week's edition of the Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass guide your way.